Your market news now. Asian stocks fell with mixed Chinese trade data and wavering enthusiasm about a peak in global interest rates. Japan's Nikkei fell 1.1%. Overnight, the Nasdaq logged a seventh straight session of gains. It's the longest streak since January. Meanwhile, in commodity markets, oil prices hit new two-month lows as mixed economic data from China offset the effect of Saudi Arabia and Russia extending output cuts. Locally, Africa's biggest mobile operator, MTN, reported 11.2% rise in core profit in the third quarter as service revenue jumped, boosted by its data and fintech businesses. To give us some more perspective on the markets, we are joined by Roy Mutuni, who's a portfolio manager at Sanlam Investments. Roy, thank you so much for your time. I mean, let's get your sense on the market right now. What's your view on what's happening right?
Hi, thanks for having me. So this market's looking very schizophrenic. Yesterday we had a good rise. It was probably 4 days of up markets, but today everything sold off on the top 40. Starting from the platinum stocks, the PGM stocks, which were doing quite well yesterday, and all the mining stocks, and now you're even seeing the banks and the big SA Inc. companies also selling off. So this is a market searching for direction. One day it's up, one day it's down. Whatever underperforms one day outperforms the next day. So it's very clear that from a macro perspective, it's the direction hasn't yet been set. And this could continue until we have a clear direction as to where interest rates, inflation, and growth are going to. So yes, negative day today, quite deeply negative actually in the top 40, and not much else.
With that said, then, we have been looking for direction in terms of interest rates and growth, and you'd wonder why the market hasn't been performing that way. Any idea what makes today different?
Well, the thing is, I think it's the trend line. So if you look at what happened last week, we were all looking to the Fed and US data, month-end data, to guide us as to where the short to medium term is coming in. And we actually got a good guide in the fact that employment is still strong, but it's weakening. Inflation is softer, and that's quite good. So I think initially what the market figured was we're in for a soft landing. It's time to buy equities. The market will rally. And then the news that starts filtering out, or the interpretation that starts filtering out, is if interest rates are going to be cut, it's not necessarily because inflation has come down and growth is holding up. It's probably because growth has actually come off quite aggressively. And what the Fed is trying to do is to rescue the economy effectively. Because remember, monetary policy is all about, it operates with a lag. And maybe they've hiked too much, and that lag now is showing us that the economy probably slows down a whole lot faster. So these two narratives are fighting each other in the markets today. And that's what you see each swing every day. Little bit of data this side, a little bit of data out of China, a bit disappointing. All of that just comes out, and it's quite clear that there's no consensus as to what the way forward is.
I want to pick your brain here as a portfolio manager, and perhaps you can give us, a lesson in stock picking 101. A lot of people tend to obsess around PE ratios. What are the flaws here when it comes to stock selection at only just looking at PE ratios?
So PE ratio is actually a very, very useful metric to use when you're trying to compare stocks. So effectively what it tells you, it's a ratio between price and earnings, and you could either have it as 12-month forward earnings, historical earnings, or current earnings. But the bottom line there is that what you're trying to estimate is the number of years of earnings required to buy the entire company. Now that's a nice back of the envelope metric, but it can't stand on its own because of nuances. Remember, when you're using the PE ratio, you know nothing about the balance sheet. And that's a very, very important consideration when you're investing in a company. PE ratios in different industries have different levels. So in cyclical industries, a high PE ratio is actually cheap, and a low PE ratio is actually expensive. Whereas in defensive sectors, high PE ratios are the norm most of the time. So you can't use it to the exclusion of everything else. You need to do your due diligence on fundamentals, on the actual functioning of the company and its position within the industry and the market before coming to a conclusion. So I think just using PE ratios on their own gives you a very, very small picture. It's actually a very dangerous way to pick stocks.
When you look back at the year so far, we're not nearly done yet. We're still in the middle of November. However, are there sectors that outperformed your expectations this year?
So when I was looking at all the sectors, and when you look at each of these companies, there were a few surprises. So the index, the top 40, well, actually the JOLTS is probably flat for the year, marginally down. But when you segregate it to sectors, the surprising thing is it's the automobile sector, that's the transportation sector that's come out on top. So there was Textainer, which was supposed to be, which is now being delisted. That was up in the 60s. Supergroup, nice mid-cap company that just delivers the earnings, and I think the market's rewarded it in a very unspectacular way with higher share prices. That's done incredibly well. Also, the healthcare companies have done pretty well as well. But on the downside, I think the big surprise is energy, because you'd have thought in all of the geopolitical complications that you have right now, energy would have done well. But between Tugela and Exxaro, and when you throw in a little bit of performance from Sasol, that's actually not been a particularly good performer. And I think the lesson here is don't look at the narrative. Always look at each individual stock, its place in its industry, your outlook, and its competitive positioning, rather than just following narratives.
And I love that you end off with that answer, not looking at the narrative. Let's talk about WeWork here, which is filing for bankruptcy. And I'm curious in terms of what do you make of this once high-flying co-working space, and also the narrative that was around this particular company, given that very high valuation?
Well, the thing is, first of all, just to put it into context, so WeWorks was this business that was going to, well, it was like the Uber of office space. So you use office space only when and if you need it. It was founded during the time of very cheap money. So that meant the hurdle for competitive ideas was actually quite low. Now, we went through COVID, and the concept of office working changed. More companies reduced the office space they required. More people wanted to work from home. And remember, for this company to succeed, they had to sign long-lived contracts. Those contracts are completely priced out in the current market. I mean, there was a time when I think 74% of their total revenue went to paying these leases.
Yeah.
So, I mean, the end was going to come relatively quickly. I think going into bankruptcy will allow them to negotiate some of these leases and maybe bring them closer to market. But again, this was a narrative stock. It was supposed to change the world. People wouldn't look at fundamentals or looking at its place in a changing environment. So
right.
I think investor beware is the caution, is the catchword here.
Well, unfortunately, we have run out of time. I would have loved to talk a little bit more with you about other tech unicorns that are out there, and given the high interest rate environment that we find ourselves in. However, Roy, let's leave it there for now. Thank you so much for your time. That is Roy Muthuni, who's a portfolio manager at Sanlam Investments. And on the back of that update that I did mention out of MTN reporting their Q3 numbers, we did see that share price up about 3.5% when that update was released, trading above 100 Rand, and it seems as though it's down about 2.25%, trading just below 100 at 95.07. Coming through as though the market is feeling a little bit optimistic given that that fall rather in the share price. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.